So yesterday, Fed Chair Jay Powell let his human side come out when he lambasted organizers at the 24th Jacques Pollock annual research conference because they allowed these climate change protesters to storm the stage just as he was delivering his remarks. Interestingly, I think Powell revealed even more of his human side, though, within those remarks, although with less colorful language. Now, even before that scene, the market had lurched into a sort of a turmoil mode after a sloppy 30-year bond auction, which illuminates the challenge, right, of finding buyers to fund our profligate government spending, particularly with the Fed out of the picture. Remember, yesterday, the 30-year bond yield absolutely soared, and of course, stocks started to tumble big time. Later on, though, yesterday we learned that there were reports of ransomware attacks on ICBC, which is the world's biggest bank, a Chinese bank, which kind of hinted that maybe any kind of bids from China didn't materialize. So with that reprieve, the market picked up on yesterday's pre-auction momentum this morning, but then we ran into another kerfuffle. Did I pronounce that right? The Michigan Sentiment Report, let's just say it's really ugly. 60.4 is the read, down from 63.8. The street was looking for 63.7, and we should note the report has been the proverbial snowball. Take a look at that. Since spiking in July at 71.5, it is going down faster and faster. Current conditions, 65.7 from 70.6, well below what the street was expecting. Here's what's worrisome. Expectations 6 months out, 56.9. The street was looking for 61. So the Fed, on one hand, it's got to be pleased, right, because they want these numbers to be this way. But it was interesting because you had worries about buying conditions for homes, cars, durables. But it was a mix, right? Some were worried because of high interest rates. Some people were worried because of tight credit reasons. That the Fed likes. The problem, though, the eruption in inflation expectations. 1 year now, people are seeing inflation at 4.4%. That's from 4% last month and only 3.2% in September. Remember, when the stock market was roiled, go back, remember, June 10th, 2022. Inflation expectations then soared. I mean, just skyrocketed to 5.4% from 3.3%. Jay Powell had to make a comment about it. He said it was eye-catching. The market caught what Jay Powell was selling. That session, this market was down to 2.9%. Then the following Monday, down almost 4%. It was really an ugly scene. And that's what makes today's report sort of a conundrum, right? Because after initially sort of losing steam on the report, we've regathered that steam and we're moving back up. I want to bring in someone who could really help us at this time, Bianco Research President Jim Bianco. And Jim, you know, I guess there's a chance that some households themselves may conflate tighter credit and inflation, right? I mean, when you're having frustration paying your bills, you're not quite sure what to pin it on.
Oh, that's absolutely correct. And that's why the Fed pays close attention to these inflation expectation numbers. And this has got to be very concerning because they like to use the phrase, you know, inflation remains well anchored. A 12-year high in the outlook for inflation, and that is on the 5 to 10-year outlook, sounds like it's unanchoring and that should be more of a concern. But the Fed seems to be consistent with this idea that they're done for now and they're happy if the market does the work for them. But if you look at what the stock market's done in the last 2 weeks, it's not doing anything that would slow the economy and hold inflation down. So if this keeps up, we might be back to talking about more rate hikes in 2024. So
let me pick up on that because I had this conversation with a couple of folks yesterday, including Daniel DiMartino Booth. And you know, to me, you know, someone said Jay Powell's upset because Bitcoin is going higher, right? I mean, how much nuance, how much nitpicking do we need the Fed to do? I mean, they can't, you know, do we need them nudging the economy and behavior every time one of these economic data points goes up or the stock market moves higher?
No, we don't need that at all. But what we also don't need for the Fed to be nudging and nitpicking the economy for decades and then some random Tuesday say, okay, that's it, we're done, do whatever you want to do. If you're going to allow the market to adjust like that all in one fell swoop, be careful, you might not like what it's about to do then. But we should have never been here in the first place. But that's the game that we play right now with these markets. And I might add, if you look at this quarterly earnings reports, they've been great. They have really been good. And what is the only thing the market reacts to right now, the stock market, is rates. It fell, the stock market went up last week when rates fell. The stock market is rebounding today because they've convinced that yesterday's auction was because of a hack at ICBC, and it wasn't because the auction was weak. And yeah, there's 500 S&P 500 earnings reports that look pretty good, but that's taking a back seat to the direction of rates right now. Everything's about rates.
I can never remember a time in my career when the first thing I did when I woke up was look at what rates were doing, right, to your point.
Right.
The other game, though, has been, and you kind of touched on it, this brouhaha over the Magnificent Seven and the rest of the 493 stocks out there. But you posted a great chart. I love this one. The Magnificent Seven versus the 2,993 stocks in a Russell 3000. That tells an even more intriguing story, right?
Yeah, it does. It shows you that the Russell 3000 includes mid-cap and small-cap stocks, including the large cap. Those stocks are up, as of yesterday's close, less than 1% for the year. And remember, last year, they had a bad year as well. Whereas if you add in those 7 stocks, those 7 magnificent stocks with a market cap of $9 trillion, you get the market up 8 or 9% in total. That's how important those 7 stocks are. So why are the other 2,993 struggling? Because of the competition of interest rates. This is the biggest dynamic we're having a hard time understanding. Go back to my earnings comment before. It's nice that the earnings numbers are up, but if I could get 5.5% a money market fund and the stock market's supposed to return me in the long term 8%, maybe I'll just sit in a money market fund. I'm getting most of the return of the stock market without much risk.
Yeah.
That's what the market has to contend with. That's why you wake up every morning looking at rates, because it's such a big competition to the stock market. That's what we're really focused on.
I think, though, once the S&P, this is my thought, if the S&P gets above 4,600, that dynamic may start to change. Jim, I love our conversations. Wish we had more time. Have a great weekend, my friend.
You too. Thank you.
All right, folks.